episode 19 of the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya,
And my name is Tamanna Surya.
and today we are absolutely thrilled to have my friend Rich Howe as the second guest on our podcast.
Thank you so much for having me. I love the idea of you two doing a podcast together. My daughter is 9, but like the idea of having her be a host on a podcast with me eventually is a really cool idea. So I was excited to see the announcement that you guys were launching a podcast, and I'm excited to be on.
Yeah, it's been a lot of fun, Rich. Rich and I have been friends for several years. I saw him in person in Boston a few years ago, and it was good to see him again in person in Omaha recently.
Yeah, that was great. The Omaha meeting is one of the highlights of my year. And Tamana, it was great to meet you as well. So yeah, no, that was a lot of fun.
Yeah, it was great meeting you in person finally. I feel like I've heard so much. We're going to jump right into it with a question I think we're always going to start with. Rich, could you tell us a little bit about yourself, your background, when did you start investing, and then what drives your passion for investing?
Yeah, great question. So I grew up south of Boston in a town called Milton, and both of my parents were involved in the investment industry. So my dad was a large cap value portfolio manager, and my mom was a bond analyst. And so for whatever reason, I always was interested in the stock market, and my dad was a really good teacher. And so we would talk about stocks. I would ask him about PE ratios and other metrics, and he would recommend books for me to read. And so I was always, for some reason, just very interested in the market. You know, I was kind of in the investment club and in high school and college and all that kind of stuff. And I knew that I wanted to be in the investment industry after I graduated from college. And in terms of what really drives me and what I like so much about investing, I don't really know what it is, but it's like the most interesting thing in the world, and it's the most exciting thing in the world. We were talking about Berkshire Hathaway in the meeting in Omaha recently, and there I was. It was just basically 4 days of being with good friends and talking stocks, and it was so energizing and so fun. And so I don't know exactly why it is that I like it so much, but it just lights me up.
You're absolutely right, Rich. It was all the other events around the main general meeting that was so exciting. You know, being with new friends, old friends you have been seeing for several years, so on and so forth. So I think going back to your core, you operate a research service called Spinoff Investing, and we were curious about what led you specifically to spin-offs.
Yeah, so I started my career at Eaton Vance, which was a large cap value or large cap asset manager based in Boston. They've since been acquired by Morgan Stanley, and it was a great place to start my career. But my focus was really on large cap stocks, so just focusing on the biggest, largest stocks. And I just find it very hard to feel like you really have an edge when you're looking at these big stocks. Everybody is really smart and highly motivated and highly compensated to have an edge, and the competition is really really fierce. And so I've been gravitated towards areas of the market that I think are just a little bit less efficient. And so I like looking at really small companies. That's really interesting to me, like microcaps. And then I just think that the spin-off market is really interesting. I read You Can Be a Stock Market Genius by Joel Greenblatt, which, I know we've all read and we all love. And it really opened my eyes to cool little inefficiencies in the market. The cool thing, I'm sure a lot of people know exactly why spin-offs are interesting, but that are listening to this podcast. But the most interesting thing is that when a spin-off happens, shares are distributed to the current shareholders of the parent company, and those shareholders don't choose to buy this new spinoff that they're receiving. And so, what often happens is that those shares are indiscriminately sold, and not all spinoffs are attractive. You know, a lot of them, have too much leverage and are spun off at the wrong time of the cycle. But it's an inefficient market, and it really appeals to me that way, that there's an opportunity to have a little bit more of an edge as opposed to looking at bigger cap stocks. So I would say that's the biggest draw for me.
Makes sense. You clearly have a lot of exposure to a wide variety of stocks. You mentioned starting out in large cap, you find microcaps fascinating, and then obviously you spend a lot of time in the spin-off world. Maybe going back into your history of investing, could you tell us about investment in any of these spaces that worked out super well for you? And then what did you learn from it?
Yeah, so I guess one good investment that I made and that I was fortunate enough to invest in is a spinoff from Anglo American, which is a British mining company called Thungela Resources. And so this was kind of a classic, really interesting setup because it was a large company spinning off a small company. It was a UK company spinning off a South African company. So, UK shareholders probably didn't want to own it. And then it was essentially going to be a small cap, almost a micro cap. And then on top of that, it was focused on coal. So nobody really wanted to own, nobody still wants to own coal, but at the time, nobody really wanted to own coal. And so it was a setup that looked really, really intriguing. And so that stock, spun off and it sold off a little bit. It didn't sell off, as much as I thought, but it started at a very cheap valuation. And it just so happened that this spinoff happened in 2021 when coal prices were just going crazy. And so I'm not, as you mentioned, I'm a generalist, so I'm not an expert at modeling coal companies, but just doing the basic, they're going to sell this amount of tons of coal per year. This is the guidance. Here's the coal price. It's going to sell at a certain discount because they're going to have to transport the coal from the mine to where it's being shipped out into the ocean, and just run some basic analysis. And it was very clear that the stock was generating going to generate a ton of free cash flow, and was going to and looked very, very cheap. And it didn't have any debt on its balance sheet, which was very, very attractive. A lot of these cyclical companies do have debt. And so that was, one that I was fortunate enough to invest in and make it a very big position for myself and, for my subscribers. And it was great. Like I made a lot of money. I made, I think I made about 100% very quickly. But actually what happened was I actually sold too soon. So I got spooked out of it because it was very volatile. And it was kind of like my position size was so big that I just thought about it so much, and it kind of what didn't allow me to think rationally. And so I ended up selling it, and then I made about 100% or so, but then it went up many more times. So I think it went up another 5x from there. It wasn't a straight line, it was a little volatile. But I would say a big lesson for me there is just in terms of sizing positions, you don't want to make it so big that you're just thinking about it at all times and you can't really think rationally about it. And so maybe, thinking back, what would have been a smart move for me was maybe make it a, pretty big outside position. And then after there's a double, if you have a double and you've made a very solid position, just cut it back to kind of more of a core size position, because I still thought the valuation was attractive, but I was just spooked by the commodity market and coal prices were starting to pull back a little bit. And so I guess that is the big takeaway, that position sizing. If you're too big, it can just make you think about nothing else but that investment, and really warp your mind and make you think less rationally than you really should.
Yeah, and sometimes, just by virtue of the fact that the investment worked out well, it can become a very large position in the portfolio. Um, so, Rich, I don't know about you, but my general trend is I buy something and then it promptly decides to drop to 10, 20, 30%. And then maybe the thesis works out in the long run. So in this situation that worked out well, did you see that it started working out well right from the outset, or did it take some time before it started playing out?
Yeah, this one a lot of time that happens to me as well, Asif. So I can commiserate there. But yeah, this one actually worked right away. And part of the reason was because coal prices were going up every day. And so it didn't, you didn't need to have a PhD to do the math to understand that they were going to generate a lot of money. And then the other hard catalyst, which was really nice, this has been helpful for me in a lot of spinoffs, is the company had a predetermined capital allocation policy such that they said we're going to return 50% of free cash flow to investors as a dividend. And so, if the stock was basically trading at price to free cash flow of about 2, and they said that they're going to generate 50% of cash to shareholders as a dividend. And I think they were going to wait a little bit, so it wasn't like it was a 50%, dividend right off the bat, but the math worked out that it looked like it was going to be about a 20 to 25% dividend at the time of initiation. And so my perspective is that that would really catch people's attention and kind of force investors to pay attention. And that's ultimately what happened. But this one actually did start working right away.
Got it. And those are the best ones. We don't have
Yeah,
to,
yeah.
there's no self-doubt and thinking, did I get this wrong? One of the unique things I've seen about your write-ups is you focus on that dividend aspect of it. You try to project what the dividend might be, and hence the dividend yield, which could be a catalyst for income-seeking investors. If suddenly is a dividend of like 7-8% and it's not a distressed asset, people will pay attention. So that's really a nice way to look at things.
Yeah, exactly. So it's like call it kind of like a dividend as a catalyst playbook. That happened with Contour Brands, and the key is a lot of times, or all the time, these spinoffs will publish Form 10s, which is their information statement. It's kind of the equivalent of like a 10K or maybe an S1 for a company that's going public, and they'll disclose oftentimes their capital return policy. And sometimes they're paying like a 50 basis point dividend or 1% dividend, and it's not really interesting. But when you can get more granularity into what the dividend is, and then you can compare it to what some of the peers are, it's really simplistic, but I've just found that it works out. And it's because one thing about spinoffs is sometimes there's not a catalyst. Like you have the indiscriminate selling pressure, but then you don't have the catalyst for the stock to re-rate. And so it's nice to know when you're buying into the indiscriminate selling pressure that once the company reports earnings and they declare their first dividend, that might be a nice catalyst to get people to pay attention. So yeah, I agree that catalyst or that dividends can be a nice catalyst.
Makes
Got it.
sense. Is there any other catalyst that you look for in addition to a dividend? So dividend seems like a very clear, nice, cut and clear one. Anything else that you look for as a catalyst?
So I like share repurchases too. So Havas is a recent spinoff from Vivendi, and Havas is not only they have to approve it. European companies, I think, have to approve their dividend. The shareholders have to approve their dividend and their share buyback policies. But Havas was a similar company where it's an advertising company, and it was sold off pretty indiscriminately, got very cheap. And one thing that, I don't think advertising is the best business in the world necessarily, or being an advertising agency, but the cool thing is that Havas was saying, hey, we're going to pay this dividend. And again, you do the math and it worked out to about a 5 or 6% dividend. And it's an annual dividend. So it's being paid all at once. And that's not that much more attractive than some of their advertising peers. But it was more attractive than many of their peers, but not all of them. And then they're also announced that they're going to do a share repurchase authorization for 10% of shares outstanding. And that's something that I always like to see if I think a stock is cheap. And then insider buying, right? You guys obviously know that well, but Peter Lynch, he said, well, in his book, I think it was One Up on Wall Street, he said one of the things that I look for recent spinoffs is insider buying because, usually you have an indiscriminate selling pressure, and that can be a really good signal that the management is excited about the spinoff because the management team usually gets a lot of shares anyway with the spinoff. So if they're going in their pocket to buy more shares, that can be a really, really nice indicator and a really nice signal as well.
Yeah, we have a screen on Inside Arbitrage called SpinSider, where it's spin-offs with insider buying, and it's a screen we look at often for ideas. Um, Rich, so that was an idea that worked out well for you. I sometimes tend to focus on the ones that didn't work out for me because I feel like I learn a whole lot more from the ones that didn't work out. Maybe I was a tourist in the industry and I shouldn't have been in there, or maybe I missed something that I should have figured out before I made the investment. So, was there one situation or investment that you participated in that didn't work out, and what did you learn from that experience, if you will?
Yeah, of course. Yeah, I mean, unfortunately, there's been plenty of situations that haven't worked out. I guess that's the nature of investing. One name that I recommend that I bought that did not work out was a company called KLX Energy Services. I don't know if you ever looked at that one, Asif, but
I did
uh,
not.
it was basically a very interesting situation where the energy services business, and this was before COVID, um, a company, I think it was KLX Inc., had two businesses. It had an air parts business, and then it had an energy services business component. And the story was that the management team was selling the aircraft parts and parts business for a very good multiple. I forget who they were selling it to, maybe BA Aerospace. And then shareholders were going to receive shares in the spinoff, KLXE, which was the energy services business. And the whole pitch, I mean, if read You Can Be a Stock Market Genius, there was a lot of signs that this could be interesting. First of all, it's energy services, it's, quote unquote, like toxic waste. Management had decided that they were going to forego their salaries and they were going to receive shares of the new spinoff every year in lieu of their salary. So that's a really interesting point. Once the spinoff happened, there was a lot of insider buying. This management team had founded KLXE and they were really well respected in the industry, and they had done a really good job of creating shareholder value. And so it looked like it was a really interesting setup for me. And so I did my analysis. I thought there was about, I think in my initial write up, like I think it looked like there was about maybe 40% upside or something if it traded in line with some of its other comps. And then I think I said that maybe there's 30% upside if we have or downside if we have a recession or the market really pulls back. But I thought this looked very attractive. And it's just comical to me to look back and think about how little downside I had. Like when you're investing in a very small company like a microcap, the downside is pretty much 100%, especially if it's levered and especially if it's in a really bad industry. And even if it's not, the market's going to overreact for these small microcap stocks. So, like, one lesson learned for me, this one obviously did not work out, but one lesson learned for me is microcaps can go to zero. There's way more downside than you think there is, and if you're investing in, especially in like energy services, like the risk reward, I forget what the risk reward was. It was probably something like what I thought was 2 to 1, but it has to be way better than 2 to 1 to get excited in a name like that. And then the other thing that I think was interesting too was one of the appealing aspects of this company was that they didn't have any debt, but they were going to go out and make some acquisitions, and the management team had a reputation for being very good at consolidating and making acquisitions, so that seemed like a good thing. But the first acquisition that they made, the debt that they had to get to pay for the acquisition was like 13% or something, mind-blowingly expensive. And at that point, I should have said, whoa, this business is way worse quality than I thought it was. If it takes 13% leverage or 12% interest to make an acquisition, the debt holders are always focused on the downside. And so, I've learned to really to really pay more attention to what interest rate the debt is of the companies that I'm investing in, because that can be a sign. And if it's like a 12 or 13% interest rate, it's probably the cost of equity the cost of equity is so high that it has to be just extraordinarily cheap for it to be appealing for me. So I guess like a bunch of lessons, microcaps downside is probably 100% or 90%. If there's very high debt loads or if there's a very high interest rate, that is a big red flag. And then the other thing that I learned was that so Greenblatt has always given us these tips about what type of spinoffs are good to look for. Like look for the toxic waste, right? Because nobody's going to really care about it. Look for the management team of the parent company who's going with the spinoff. And I think those are probably still good. That's good advice. But at the same time, it's not foolproof, right? Like we had the management team go with the spinoff. We had the management team forego cash salaries for stock. It looked like quote unquote toxic waste, and it turns out it was toxic waste. And so a lot of lessons learned from that one.
Yeah, Rich, the whole decade before COVID, anything to do with energy, whether you were in upstream, midstream, downstream energy services, it was just extremely difficult. I was in multiple positions, but as I mentioned, I was a tourist and got hurt during that period of time. So now when I look at something like energy services, the red flags go up first in my head and then everything else comes later. So fully understand the toxic waste part of that situation.
100%.
Actually, how do you find a good way to differentiate between what is actually toxic waste and then what just appears to be toxic waste?
It's an awesome question, and I think that's like the $1 million question. And I think it just comes down to judgment. So like the thing that like Thungella looked like toxic waste. This was the coal spinoff from Anglo American. And there was actually a short report that came out at the time of the spinoff that said, hey, their environmental liabilities, the liabilities that they have and that they're going to be responsible for in terms of shutting down these mines is more value or is a bigger liability than the entire capitalization of the company. And so like that sounds like toxic waste. So I tried to do as much work as I could to understand that. But ultimately what got me comfortable with Thungella was that they didn't have any debt. They were really well capitalized. And then I knew that I wasn't going to own this name forever, and that turned out to bite me because I ended up selling it too soon. But what I did was I knew I wasn't going on forever, and I was like, hey, I'm going in. They're printing cash right now, and I know they're going to declare a 25% dividend. So that is going to be a nice catalyst to get the stock moving in the right direction. But ultimately, it all came down to judgment. I mean, I'll give you another example. So Garrett Motion, which is a name that I actually own right now, I didn't own at the time of the spinoff, but Garrett Motion is a turbocharger business. Turbochargers help internal combustion engines operate more efficiently and with releasing fewer emissions. But the world is going electric, and electric cars are taking share, and so the long-term future for internal combustion engines is not particularly attractive, and so that kind of looks like like a toxic waste situation. And then this business was spun out of Honeywell, and it also had an asbestos liability that Honeywell just stuck on the balance sheet for Garrett Motion. And the turbocharger business has nothing to do with asbestos. It's not like the turbocharger business generated the asbestos liability. Honeywell just decided to stick this liability on their balance sheet and spin it off to investors. And in that case, you had a company which, was cyclical. I think this was 2018 or 19, getting spun off at the peak, not that we didn't know if it was the peak or not, but it had been a long time of a bullish economic cycle. It was in the auto industry. The auto cycle was kind of at the top. This company had a lot of debt, and it had billions of dollars of asbestos liability. And so this was a situation where it looked like toxic waste, and it was toxic waste. So but it looked really cheap, and a lot of people invested. But Garrett Motion ended up declaring bankruptcy to basically confront and deal with the asbestos liability, because they argued that Honeywell stuck them with this liability unfairly. And the only way for Honeywell to really come to the table, instead of just ignoring Garrett Motion's questions and appeal, was to declare bankruptcy and force a judge to make a decision as to whether or not sticking Garrett Motion with all these asbestos liabilities was fair. And the judge ruled that ultimately, it wasn't, and those liabilities got reduced significantly. But it's a tough question, because oftentimes not great businesses are spun off. Usually a company wants to stick with its secular growing business. And so it's a question that you have to think about a lot, like what is toxic, what is actually not toxic, and it just comes down to judgment, I think.
Makes sense. Makes sense. I know you mentioned that like the companies get stuck with a lot of liabilities. The companies that are spun out rather get stuck with a lot of liabilities. We actually see that quite often. When the parent spins off a company, that spin-off is loaded with a ton of debt. How do you think is the best way to navigate that as an investor?
Yeah, so I think it's important to think of, I guess, I mean, oftentimes the good thing is that the debt is usually it's termed out, so it's the maturities aren't going to happen for like 5 or 6 years. So I guess that gives you some level of comfort that hopefully the business will be able to manage itself and manage its debt load. But I think ultimately it's like you just got to go through every one and see if you think the business can handle the debt load. Um, I mean, an obvious thing that I've already mentioned is just to look at the interest rate. So, like, where is this debt priced, relative to other names? Is it priced, at 13%, and that's maybe a red flag, or is it priced, sometimes debt is priced at such a low level, and I'm actually surprised, and I'm like, oh wow, this is maybe a higher quality business than I thought. But things that I look for, are recurring revenue, margins. If margins are pretty high, that gives you that you're usually going to generate some good cash flow to be able to pay down and delever that way. But it's cyclicality, like Magnera is a recent spinoff, and that is focused on producing wipes and diapers and things of that sort, and they have a good amount of debt, and that's a company that I'm a little worried about. The good thing is the debt is really termed out, so we're not going to see any maturities anytime soon, but so they would have time to correct the ship if they run into any issues. But there's not much for companies like that are economically sensitive. There's just not much room to maneuver. If you're in an economic downturn and your revenue comes down, your margins come down, it can be a tough situation.
Got it. So, Rich, switching gears a little bit, as you mentioned, a company that is planning on spinning off a division forms a Form 10 with the SEC, but they announced the spin-off several months or maybe even years before they do that. Um, so, beyond looking for the Form 10s or the announcements, do you rely on any other sources for idea generation? Basically, how do you come up with ideas that you want to explore further?
Yeah, so generally what I'll do is I will obviously follow all the Form 10s that come out and see what's been published. I will try to track them, so I have a bunch of Google alerts that just flag when there's any other spinoff announced. And what I try to do is I try to just do some preliminary work to see if there's some of the parts unlock. Like sometimes it's pretty clear that it looks like there's a situation where the spinoff is going to unlock value. For instance, when Liberty Global announced that they're going to spin off Sunrise Communications, again, one thing that they announced at the time of the spinoff was that Sunrise was going to pay out. They announced the dividend that Sunrise was going to pay out, and so you could just kind of do the math and figure out what the implied share price was going to be of Sunrise, or have a range of outcomes that would be a fair range. And it was just it was obvious to me that this was a transaction that would unlock value, and it has. But yeah, generally I'm just looking at the Form 10s. I'm trying to do some initial work to see if is this so compelling that I need to jump on it today. I'm fortunate, Asif, like you are, to have a lot of friends in the industry who are constantly also looking at special situations and spin-offs, and they're saying, oh, look at this one. This one looks interesting. IDT was a company that somebody just emailed me, and that actually hasn't spun off any businesses, but it has spun off a ton of businesses in the past. And I know it's like a spin-off machine. And so somebody said, hey, look at some of the parts, the story, it looks really compelling. And so I said, oh, that does look compelling, and that's been a really great stock. So yeah, it's just I would say it's doing Google alerts, reading the Form 10s, talking to my network, and then also it's really helpful. Like you, I'm not an industry specialist, so I actually find a lot of people poo-poo sell-side research, but I actually get a ton of value from it. And I don't get a ton of sell-side research, but sometimes people will share sell-side research with me. And it's very helpful because those analysts are experts in the industry, and they can point you to the right comps to look at and help you construct your sum of the parts analysis. So I would say those are really the main sources of kind of what I look for when I'm trying to get up to speed on a situation.
Yeah, I remember meeting IGT CFO at a conference, and then I spoke to him after that. And yeah, the spin-off would be the catalyst for that company, considering all the different divisions that they have. They have that retail point of sales service business that they have in Mexican bodegas and things like that. So I'm watching that one as well, but haven't started a position yet.
Yeah, that one's interesting because I almost respect the decision not to spin off anything yet, because they have their traditional telecom business, which generates a ton of cash, and then they use that cash to basically start and fund new businesses, and typically they spin those businesses out. But one of their businesses, the business that you were talking about, this NRS point of sale business, is just a terrific business with like really good EBITDA margins, very low capex, and it's growing like crazy. And they're rolling it out into convenience stores, bodegas. I think they're adding something like 1,500 new terminals, per quarter. And like that business could become the whole, IDT. So like my favorite situations are where a stock is cheap on a sum of the parts basis and it's cheap on a consolidated basis. And I think IDT's, cheap on both metrics. But usually, because I know you can get really hurt in value traps when your thesis is sum of the parts and there's not any growth, and you're just waiting for a value unlock that never happens. So I'm very careful investing in companies that have a sum of the parts story, but no plans to spin anything else off. But in the case of IDT, I'm happy to make an exception just because the business, especially that NRS business, is doing so well.
Makes sense. Speaking of finding ideas, that was a fascinating insight throughout it all. You've published two really interesting write-ups about some recently completed spin-offs, Resolute spin-off from CompoSecure, and the final separation of the Starz business and Lionsgate. We're going to start by pulling at that Starz and Lionsgate thread, and then we'll move on to the CompoSecure Resolute situation. But that's always fascinated me, the Lionsgate and Starz separation. I think it's the company I've written about the most. And I always call it a special situations bonanza because it feels like there's always some sort of special situations activity going on at Lionsgate, whether that be insider purchases, activist involvements, possible sale, and then finally, the heart of it all, the spin-off. I think most viewers would be pretty familiar with Lionsgate just due to their very famous brand of movies that they have released, including The Hunger Games and so on and so forth. But for those who may be unfamiliar with the two companies, could you just introduce them and then we'll get into the rest of it?
Yeah, for sure. And then not only did they have the insider buying, they have the activist, they have the spinoff. They're also a SPAC, right? So like Lionsgate
Right.
Studios went public. So it's like it is a special situation wrapped in a special situation. Yeah, it's like a special situation bonanza. That's a good way of describing it. Yeah, so I'll give like a high level overview maybe, and then
Mm-hmm.
feel free to jump in with questions. But basically right now there's two businesses. So one is Lionsgate Studios, and Lionsgate Studios is a studio that is independent and is focused. About 50% of revenue comes from, motion picture, so movies, and then about 50% of revenue comes from television production. It has a reputation, and I know you guys know the name too, so I'd love to get your insights as well. But really, as kind of a nimble, more franchise driven independent studio. So they typically have a successful movie, and then they'll come out with additional if the movie does well, they'll come out with John Wick 1, John Wick 2, Hunger Games 1, Hunger Games 2, Saw 9, 10, 11. And what is great about this is it takes down the risk. Instead of coming up with a brand new concept that you don't know if it's going to do well or not. Usually that you have a dedicated audience that is going to want to watch the movies. And then they do have a reputation as really talking about or just focusing on cost and being very cost conscious. I was, in Omaha recently for the Berkshire Hathaway meeting, and I was talking to somebody about that, and he was from LA, and I said, what's the reputation of the Lionsgate studio? And he was like, this is probably good for the stock, but they don't pay particularly well. They're very focused on the bottom line. And so from my perspective, that is definitely something that is a positive for me. Lionsgate Studios is also one of the last independent studios. So the last big studio that got bought was MGM by Amazon, but there's been this content battle where all these streamers and big tech companies are trying to build up their content portfolios. And so, part of the thesis is that this company, once it's independent and separated from Starz, could be a good acquisition candidate in terms of the movies that they're kind of more well known for. It's John Wick franchise, it's The Hunger Games, it's Dirty Dancing from a little while ago, and La La Land I think is another movie that they produce. So I'd say the bulk of the value in the stock right now is the studio business. And Lionsgate Entertainment owns 87.2% of the studio business, which went public via SPAC. The SPAC trades under the ticker LION. And so what's going to happen pretty shortly at some point in May is the Lionsgate Entertainment is going to spin off the studio business. So they own 87.2% of the business. They're going to dividend that out to shareholders. And then the remaining business is going to be called, renamed Starz. And Starz is kind of an interesting little business. It's an independent streamer that will just be completely independent, and it's pretty reliant on Lionsgate Studios for its content. But it is very focused on. It has about 20 million subscribers. It's very focused on a niche of the market, primarily African American females. So that's the part of the market that it really caters to. This is an appealing aspect, or an appealing category demographic for many of the other streamers who don't have as much insight into that part of the market. And so for that reason, Starz hasn't been successful historically bundling Starz with other packages like HBO Max and Disney Plus, but they're really leaning into that, and I think that's a really interesting opportunity. And so, by the end of May, I think, there hasn't been a press release that I've seen yet, but at the end of May, we're going to have two completely public companies. One company is going to be called Lionsgate Studios. It's going to trade under the ticker LION. And then the remaining company, so the parent company, is going to be renamed Starz, and its ticker is going to change to STRZ. So that's a little bit of an overview, but I'm, of course, happy to give more details.
That was a wonderful overview, Rich. And they're also collapsing, I think, the two classes of shares, Class A and Class B shares. So all that would go away. You mentioned La La Land. That is a favorite movie of my younger daughter. And one of my favorites from like 10, 15 years ago, I don't remember how long ago, was 310 from Yuma. I think Russell Crowe was in it. Christian Bale might have been in it as well. And I'm just waiting for 320 to Yuma, 330 to Yuma, and 410 to Yuma to come out if they decide to capitalize on that franchise like they've done with Hunger Games, Saw, and so on and so forth.
Yeah, that would be consistent with the brand. I didn't know that movie. I never saw that movie, but I know it's really well, critically acclaimed. I'm gonna have to watch that one. I didn't know. I actually didn't know that Lionsgate created that movie.
Yeah, it's a good Western movie, and you would see this with Lionsgate stock if you followed it for 20 years, that they would have this big hit, the stock would jump up, and then it will come right back down again. But what you mentioned about MGM, Amazon acquiring MGM Studios, is what really drew our attention to Lionsgate this time around. I've invested in it on and off for 2 decades. But the fact that it seems so undervalued compared to what Amazon paid for MGM seems to be a core part of our thesis for owning it.
Yeah, it's tricky for me because I'm looking at the business, and it's like you look at the financials, and it's not the easiest business to understand, and it is a little lumpy. Some years are good, some years are bad, and it's a really tricky business to fully understand, the studio business. But like in doing work and in doing my deep dive to really understand the spinoff, what was really clear to me is that there's just a ton of strategic value, to your point, Asif. So Lionsgate Studios has a slide in their presentation which talks about all the precedent transactions that have taken place in the past and the multiples. So, Amazon bought MGM for 28 times EBITDA. Disney bought Lucasfilms for 16 times EBITDA. And then there's a bunch of other ones that go as high as 42 times EBITDA. And I kind of thought, oh yeah, maybe there's strategic value there, but maybe that's Lionsgate Studio really trying to make a good case. But just the more you dig into it, like Sony, I think, has tried to buy a studio. They're trying to make their studio bigger. So it just seems like and then Apple and Google and Netflix, they all want content, and there's limited supply of content, and there's a limited number of studios, and it just seems like there's a lot of strategic value in the studio. And then the other thing that I was really encouraged to see was that there's a lot of private equity interest as well. So Blackstone, they bought Reese Witherspoon's company for, I think Reese Witherspoon's company generated only about 140 million of revenue. Blackstone paid $900 million for that. KKR invested in Skydance Media. They're still invested in Skydance Media. One of the comps that I used to try to understand Lionsgate Studios valuation was Skydance. I think that's a pretty good comp. And then Apollo Global also invested in Legendary Entertainment, which is, I think, a notch below Lionsgate. And I couldn't get the exact valuation, but it was I think Apollo invested about $760 million to acquire a minority stake. And I think Legendary Entertainment has less revenue and less hits and less IP than Lionsgate. So it does seem to me that there is surely strategic value. And one thing that's appealing to me too is that, like, I just think rumors are gonna, once this thing starts trading by itself, like, I think whether or not an acquisition happens this year or not, there's gonna be rumors that come out. I mean, when Paramount was being shopped around, everybody and their mother, it seemed like, wanted to put in a bid. I mean, even Barry Diller at IAC was like, yeah, I got to look at it. I got to take a look at it. And so I think it's kind of like when a sports team comes up for sale, it really draws some potential buyers out of the woodwork. And so, yeah, I agree. It does seem like there's a lot of strategic value. Maybe 2021 was a little overhyped, but I still think there's strategic value, especially relative to Lionsgate Studios' current valuation.
Interesting. I think the fact that they have it in their presentation now, talking about all the prior acquisitions, is so fascinating to me because every time I look at the parent company Lionsgate stock, I always think back to a couple years ago. I'm forgetting the exact year, but I think Hasbro made an offer for Lionsgate for $40 per share, and I remember the chairman Mark Richeski saying that overvalued the company. And it's never traded at that $40 per share since. It just continued to drop and drop and drop. So that the fact that they're highlighting the possible option of a sale in the future is interesting. Do you think management is more open to that now? Is there a question of any entrenchment at the company, especially considering management has been with it for so long?
Yeah, it's a great point. I really think that they are open to it. So this transaction is structured as taxable, and both, so as far as I understand it, both Starz and the spinoff Lionsgate Studios, there's no 2-year holding period on when this thing can't get acquired, and it seems like they're going to be open to doing the right thing. At least that's my impression. After talking to investor relations. And then, as you guys know, as well as I do, there's activists in the stock, right? So Liberty 77, I think, owns, I don't know if my math is right, but according to Koifin, about 13% of the stock. And then MHR Fund Management owns about 19% of the stock. And so I think there's going to be pressure on, especially if this thing doesn't re-rate a lot higher. I think there's going to be pressure for somebody for them to sell the business, and I think they would be open to that. And then there's no two class of shares anymore. To Asif's point, that protection is gone. I mean, another thing that I think is interesting, and I have no inside knowledge here, is that Lionsgate Studio isn't really in any indexes right now because the float is so low and because of the dual class of shares. But it's a $2 billion market cap, and I think it's undervalued. And the average market cap for an S&P 600 company is about $2 billion. And then the Russell reconstitution is coming up in May, in June. And, so I think it's possible that this company gets added to both the S&P 600 as well as the Russell 2000. And then you have the activists, and you could have some activist rumors swirling. And so, yeah, I think it's a really, really interesting setup.
It's interesting that there's activist involvement both in the parent company. We've been seeing the Liberty 77 insider purchases for quite some time now, and that's always been another part of our thesis. I think there's also activist involvement in the spinoff as well, Lion, what's trading as Lion. Anson Funds, I think, took a position in late December of last year, and has been encouraging the company to explore a possible sale after the completion of the spinoff of that 87.2%.
Yeah, there's a lot of activists, and so I think that's only a positive, honestly. And, like, I don't know, I just gotten burned. I mean, I got kind of burned by Bill Ackman with him announcing that he's going to take Howard Hughes private, and then, like, the stock ran up, and then turns out he's not going to take it private, or he's going to charge a big management fee. Invest some money and charge a management fee. And so, I don't think I need to own, Lionsgate for its for the last dollar necessarily. But if there is some rumor swirling and there's more activists that are increasing their position, I think that's going to be good for the stock. And I think it would probably be up significantly from where it's currently trading.
Yeah, it's fascinating situation overall, Rich. I think you and I and Tamanna could talk about this for the next 4 hours, if given the chance. I wanted to very briefly touch upon Resolute and CompoSecure, another spin-off that's fascinating because of who's involved in the spin-off. And then we have a set of rapid fire questions. So we'll keep the Resolute discussion very brief and then maybe invite you on back on the podcast to talk about it at a later point in time. So as you know, Rich, Resolute was spun out of CompoSecure, I think, towards the end of February this year. And it's dropped quite a bit. Based on my numbers, I see it's down about 44% since the spin-off. CompoSecure is also down about 16%. CompoSecure, as I read in your write-up, they basically are the manufacturers of premium metal credit cards. So when you think of the Robinhood Gold card that everybody finds so fascinating, I need to get my hands on one of those. That is, created by CompoSecure. So, Rich, could you briefly touch upon what CompoSecure does and why this spun out Resolute and why it's so interesting for both of us?
Yeah, so it's I think you did a great job of describing CompoSecure. So I don't even know that much more about that business other than that they're involved with specialty manufacturing, and their primary vertical right now are these metal credit cards. So the Amex Platinum, I think they do that one. I think they do the Robinhood Gold card, and they're cool. I mean, it's like they're just more sturdy, and I do like that niche, and I think it generates good margins. So what happened recently was, or I guess last year, so David Cote, and I think this is why this is interesting. He formerly did a great job in terms of managing Honeywell and doing a ton of acquisitions with Honeywell and really building up that business. And then he switched and he worked at Vertiv for a while, and he did a similar thing where he grew a lot organically but inorganically. And his new latest target is CompoSecure. So he's made a big investment in CompoSecure. And then about 6 months after he did that, CompoSecure announced that they were spinning off this business called Resolute Holdings, which was spun off in late February, as you said. And it was the most bizarre spin-off Form 10 document that I read. It basically, what CompoSecure or what Resolute Holdings does is they provide oversight of capital allocation strategy, operational practices, and mergers and acquisitions sourcing and evolution. And I was like, why are you doing this? Because the whole point of David Cote coming in and investing is because like he can bring that, right? He can invest and he can use his M&A chops to make really good deals and increase the stock price of CompoSecure. And I'm like, why in the world are you spinning off this business? And I said, do you want to, monetize David Cote and expand to other companies? So not just CompoSecure, but provide that service for other companies. And investor relations, at least they told me, no, that's not the plan. They just thought that this strategy, would be interesting. And they said, hey, all shareholders are getting access to this. So we're just basically kind of splitting up the economics. Because from my perspective, Resolute Holdings is kind of siphoning off a lot of the economics from CompoSecure. So the way that CompoSecure gets paid is they get basically 2.5% of trailing 12-month EBITDA every quarter. So basically, Resolute Holdings gets 10% of EBITDA of CompoSecure, and that works out to about $15 million of revenue. Now, right now, Resolute Holdings has about $15 million of cost, so the business does not earn any money. But the thing that I'm really trying to spend my time thinking about and really understanding is how many acquisitions is CompoSecure going to make? Because just to go wild, like let's say CompoSecure right now has a billion and a half or 150 million of EBITDA. Let's just say they go crazy and get up to $1 billion of EBITDA, then 10% that would go to Resolute Holdings. So Resolute Holdings would have basically $100 million of revenue, 15 million of cost, that have $85 million of very high margin, 85% margin revenue. And presumably that business would trade at a very, very high multiple. And so the big, I think the $1 million question is like, how many acquisitions is CompoSecure going to make? Um, and I haven't got the answer to that. So if anybody listening has some insight into that, I would love to hear. And it's something that I'm going to be spending some time with, because I think that's the most important thing.
Yeah, and another thing I'm thinking about there, Rich, is the next step beyond that, right? So, what are they going to do in terms of advising other companies? Are they going to start advising other companies that will then bring in additional revenue? And does this end up becoming the next big investment bank or a private equity firm like Apollo or KKR? I just don't know how this whole thing ends up 5 or 10 years down the road.
And that's what kind of, I think that's what they want. I mean, they've said like alternative asset managers trade at extremely high multiples, and this is basically an alternative asset manager. And then the other thing is the CEO of Resolute Holdings is a guy named Thomas Knott, and he used to be head of permanent capital strategies at Goldman Sachs and CEO of CEO of one of the SPACs. But basically head of permanent capital strategies, like a pretty big role at Goldman Sachs. And so like, what is this guy doing at a 200 million market cap company, right? Like kind of interesting. Um, so yeah, I think it's fascinating. It's on my watch list to do a little bit more work and to just kind of like independently think about, how big could CompoSecure get? And then, yeah, are they going to expand into advising other companies? And because I don't think the stock, looks very. It doesn't look cheap now because there's no earnings, but a couple big acquisitions, and it could look very reasonable, very cheap.
Got it. And it's interesting that the fee is 2.5% of adjusted EBITDA and not like 1.5% of market cap that Bill Ackman wants to do with Howard Hughes. So in that sense, it's a little bit better for investors of CompoSecure.
It's way better than that, because it basically CompoSecure is now externally managed, essentially, right? They have a management fee from this vehicle, but all investors got access to that. All investors got their pro rata allocation of this new business. And so like, I think that would be a much better solution for Howard Hughes, where like, hey, you all get access to this vehicle, you get your pro rata share, and it's going to charge a management fee, but you all get access to it, right? And it should trade at a really high multiple because it's an asset management business. So I actually, it's a strange transaction, but I actually like it a lot better than what Ackman is doing with Howard Hughes.
Makes sense. Something completely unique. I don't think anyone's really seen a spin-off like this
No, I
before.
certainly haven't.
Exactly. We're going to switch over to the rapid fire questions to just wrap this up. So thank you so much so far, Rich. I think we'll start off with, we talked a lot about books during this podcast. I think we mentioned Greenblatt, we mentioned Peter Lynch, so on and so forth. Was there any book you recently read and found any actionable advice from?
Ooh, that's a great question. So I'm just trying to think of the recent books that I've read. So I've read I always have a couple books going, because when I read business books, sometimes it gets me too fired up and I can't fall asleep. So I read on my Kindle, and I want to go to sleep, but if I'm reading something really exciting, like it gets me too fired up. So the book that I have that is puts me to sleep, but it's really interesting, is there's a biography of Dwight Eisenhower. Um,
Interesting.
and it just, president, became president. He was, the supreme commander, I think, of the Allied forces during World War II. Like, that book is really, really fascinating. I love history, and so that book is really interesting. But it definitely puts me to sleep. I'm actually reading it for the second time, and it's like there's a lot of stuff that I missed around the first time. So that's one book. I don't know if there's anything really necessarily actionable from that book. Another book that I'm rereading again is James Clear, Atomic Habit. Have you guys read that one?
I have,
I have
yes.
not personally,
So
but
I
we'll
just
check it out.
love habits, because it basically helps you transform your behavior. So it's like, it's everybody wants to do big things, wants to be effective, wants to be stronger, eat better, and get more work done. But it all boils down to like, what are your daily habits? And so like, I really like that book, because it basically tells you to kind of break your habits down into really small chunks and make them so that they're easy to do, and then you can kind of slowly increase them from there. Like, for one thing, is like, if you want to get stronger at push-ups, like, don't do 30 push-ups a day, do one. just do one push-up. Like that's all you have to do and get that habit going. And then maybe after a week, do 2 push-ups. Like that's so easy. But then you get in the habit of doing push-ups and the habit's built, and then it's really easy to just do that on a daily basis. Another thing that he said was just like to make things really hard. So if you have a bad habit and you want to get rid of it, make it really hard or really inconvenient. So like one thing that I do is like if there's candy in the house, like I will just eat it all. So if there's leftover like Easter candy, like I'll just eat it all. And so just get candy, get sweets out of the house, and you won't be able to eat it. But or if there's something that you want to do, like you want to go to the gym, make it really easy. Like set up the coffee so it's ready to go the night before, in the morning. Put your gym clothes out. So like all you have to do is wake up and you don't have to pick out your gym clothes. They're right there. And so I really like that book. I think it has a lot of actionable advice.
He had example in there about where the vending machine was positioned, and just making it a little bit inaccessible made people go get less sugary drinks.
Totally.
Probably bad for the vending machine operator, but good for the employees that work there.
Definitely.
I think we'll move on to another one of these rapid fire questions. How have you found mentors in your investing journey, and how have they made a difference in your investing journey? And could you talk about any of your mentors that you do look up to?
Yeah, it's funny. In terms of the mentors that I've had, so like I feel like I don't know if this is probably not a mentor, but it's my dad. I was kind of lucky to have my dad, who was really helpful in terms of just being really open about answering any questions, no matter how dumb it seemed. So like that was really helpful for me. My boss, I worked at City Private Bank for a while. My boss there was super supportive of me, really had my back. I think I really appreciate that. And we've actually, he left City, and we're still working together in some way. So that has been really helpful. I've also learned a lot just from like peers. Like I feel like one thing I value, like us, if we talk, every 6 months or so about like what's working in the business, what's not working in the business, or we'll meet up at
Mhm.
Berkshire, or when Asif's in Boston. So like I find that incredibly valuable to just like talk to your peers and ask questions and compare notes, because everybody's working on a lot of the same problems. And it's, you don't have to create the solution yourself. Maybe somebody else is thinking about it, and has figured it out before you, and you might as well use that, use their knowledge. So yeah, I think mentors are incredibly important, but also I think just as important are just like peers that you connect with and can learn from.
So, Rich, I've been trying to listen to more and more podcasts, if you will. I listen to Morning Brew every morning. I try to listen to Andrew Walker's Yet Another Value podcast. Invest Like the Best is another really good one by Patrick O'Shaughnessy. And you launched one on Spinoff. So I try to make sure I get to every single episode you release, because you do deep dives on individual spin-off situations. Are there any podcasts that you are finding useful, that you try not to miss on a daily, weekly, or a monthly basis?
Oh man, I love podcasts. They're just so good, and there's something about they're just perfect to listen to like when you're driving. Like I'll drive to the library, or I'll be by myself, or I'll be driving to a meeting, and it's just so great. Like I can't just sit down and watch a podcast or listen to a podcast, but if I'm going for a walk or a run, it's just a great way to consume, because you let your brain kind of go, and then if you have any insights, you can just like pause and take notes. So I definitely love podcasts as well. So one podcast that I really like, and I definitely don't see that, I don't listen to them all because they do so many of them, is a podcast. Have you guys heard of My First Million podcast?
I have not.
I have not
So it's
either.
definitely not an investor podcast per se, but they interviewed Monish Pabrai. It's just really interesting and entrepreneurial. It's more about business and like starting a business and growing your business and what kind of businesses work. The guy who started it is started a business or a newsletter called The Hustle, which he ended up selling. They had the guys who started the Morning Brew on to talk about the newsletter business and how it's changed since when they started it. So that's what I would say, that is my favorite podcast right now. But one of my friends loves Founders podcast, I love history and I love biographies, and so he said that basically that's all it is. It's, it'll be a biography of Richard Branson or whoever, and so that's another one that I want to check out.
Makes sense. Great, great recommendations. I'm going to have to check some of these out as well. We're going to wrap up with our two last questions, kind of opposite of each other. We'll start with the first one. Do you have any bucket list items or something that you've always wanted to do but never have?
Yeah, so one thing that I've really wanted to do is to go skiing in Utah for some reason. So I'm in the Northeast, and I ski in the Northeast, and that's fine. I like it. That's just what I'm used to. But the conditions aren't great. It's usually really, really cold, but there's not that much snow, and it's really icy, and it's windy. And so like I really want to ski. I've skied in Colorado, but I've never made it out to like Park City or Deer Valley. And so I think we're gonna try to make it out to Utah in next January to do that. So that's been on my bucket list, and that's one thing that I'm looking forward to checking off.
So both of us enjoy skiing as well. So Rich, maybe we should launch a special sits conference together and have it be in Park City, Utah. And
Let's
our
do it. I'm in.
subscribers and people who are listening to this can let us know if they'll find that interesting.
I would
Yeah.
love that. I would love that.
I have to say I am a terrible skier, but I enjoy it completely. Even though as I'm completely scared and terrified as I go down the mountain, it's a wonderful feeling at the same time. So
It's totally, yeah. I'm not a great skier by any means, but it's just fun, and it gives you something to do in the winter. In the Northeast, the winters are like long and cold, and so it kind of gives you something to look forward to on the weekends.
interesting. I think we'll wrap up with our last question then. Kind of the opposite of what I just asked you about something you've never wanted or something that you've never done before. What's something that you'll never do?
Ooh, something that I'll never do. Just something that yeah. Can you give some context about maybe other answers, or is it anything?
For me, it's I think it is bungee jumping or skydiving. Those
Mm-hmm.
things are on the never do list.
Yeah, I would say same thing. Not to jump on that, but I would never. Yeah, I think I would skydive. Like I think that sounds interesting, but bungee jumping for me just sounds. You're too close. Like you see the ground coming. Whereas I feel like if I was jumping out of an airplane, it would be like you're so high up that you're like, oh, this is fine. I'll just do it. So yeah, I guess bungee jumping will be something that I will never do.
I think as well professionally for both of us, it's not using leverage for
That's right.
that's another
Yeah,
one I don't think
that's a
I'll
great
ever
idea.
do.
Yeah.
I think we should now wrap up saying what we should have said at the beginning of the podcast. Nothing in this is investment. In this podcast is investment advice. We are not recommending buying, selling any securities here. You should do your own due diligence and consult with your investment advisor.
And thank you, Rich, so much for coming on our podcast today. This was an absolutely wonderful conversation from start to finish.
Thank you guys so much for having me on. I love meeting you all in Omaha, and this was really fun to connect afterwards. So really appreciate you guys having me on.
Absolutely, Rich. Thank you.
And that wraps up episode 19 of the Special Situations Report. We had an interview today, but if you'd like to access a comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool. Check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. If you have any comments or feedback that you would like to share about who we should have on as a guest next time, feel free to do so in YouTube or Spotify. Thank you.